Most founders think corporate venture capital is just another funding source. Investors know it's actually a strategic alignment decision disguised as capital. And that misunderstanding? It costs startups control, optionality, and in many cases, their entire exit pathway. Because when you take money from a corporation, you're not just raising capital, you're entering an ecosystem with incentives that may not match yours. Today, we break down what corporate venture capital (CVC) really means, from both an investor's lens and a founder's reality. And more importantly, when it accelerates your growth and when it quietly limits it. Corporate venture capital is capital deployed by large corporations into startups, typically through a dedicated investment arm. But here's the key distinction. Traditional VCs invest primarily for financial returns. Corporate VCs invest for strategic and financial outcomes. That means market access, technology integration, competitive intelligence, future acquisition pipelines. CVC exists because corporations face a problem. They can't innovate fast enough internally. So instead of building everything, they invest externally. Where does it fit in the startup lifecycle? Early stage strategic experimentation, growth stage ecosystem expansion, late stage acquisition positioning. Who cares about CVC? Founders, capital plus partnerships. Investors, signaling co-investment dynamics. Corporations, future-proofing strategy. Boards, governance plus risk exposure. CVC sits at the intersection of capital, strategy, and control. If you ignore how CVC works, you risk becoming dependent on a single corporate partner, limiting future investor interest, blocking potential competitors from investing, weakening your exit optionality. But if you understand it, you unlock faster market entry, enterprise-level distribution, credibility with institutional investors, strategic acceleration that pure capital can't provide. Financial implications. Valuation may increase due to strategic backing, but future rounds may become more complex. Strategic implications. You may gain access to massive infrastructure, but lose flexibility in partnerships. Risk exposure, misaligned incentives, slow decision-making cycles, internal corporate politics affecting your startup. Bottom line, CVC is not just funding, it's a strategic commitment with long-term consequences. When institutional investors see a CVC on your cap table, they don't just see capital. They analyze, 1, strategic alignment. Is the corporation helping growth or controlling direction? 2, dependency risk. Can this startup survive without the corporate partner? 3, market signaling. Does this validate the startup or scare away competitors? 4, exit constraints. Will this corporate investor block acquisition opportunities? Red flags investors watch. Exclusivity agreements, IP ownership complications, over-reliance on one distribution channel, board influence skewed toward corporate interests. What makes investors lean in? Clear independence from the corporate, multi-partner strategy, defined boundaries, strong standalone business model. Investors don't just ask, who invested? They ask, what does that investment now control? This isn't about blaming founders, it's about elevating thinking. Common myths. Corporate backing guarantees success. Strategic investors are always aligned. More capital equals less risk. Reality. Strategic investors have their own agendas. Priorities shift with leadership changes. Internal teams may not support your product long-term. Execution gaps. No clear partnership boundaries. No diversification strategy. Overestimating speed of corporate execution. Strategic blind spots. Ignoring how other investors perceive the deal. Not modeling long-term exit scenarios. Underestimating governance complexity. The biggest mistake, treating CVC like traditional VC. It's not. Let's make this actionable. CVC evaluation checklist. Ask yourself, what is the corporation's true objective? How does this align with our long-term vision? What restrictions are attached to this capital? Will this limit future partnerships or investors? What happens if this relationship ends? Risk mapping approach, MP nerd style. Idea risk, is this partnership necessary? Demand risk, does this validate real demand? Business risk, does it distort your model? Execution risk, can you deliver within corporate constraints? Growth risk, does it limit scalability? Credibility risk, does it enhance or complicate investor perception? Strategic positioning approach. Keep optionality open, avoid exclusivity where possible, maintain independent revenue streams, structure governance clearly. This is where structure beats speed. Startup A accepts corporate funding with exclusivity agreements, heavy integration dependency. Result, fast early growth, but limited future investors. Acquisition options shrink. Outcome, short-term gain, long-term constraint. Startup B accepts CVC with clear boundaries, multi-partner strategy, independent growth channels. Result, slower initial ramp, stronger investor interest, multiple exit opportunities. Outcome, controlled growth, scalable future. The difference, not capital. Structure. Here's what most people don't see. Second-order effects. Competitors may avoid partnering with you. Talent perception shifts. Market positioning becomes tied to the corporate hidden risks. Strategic priorities change overnight. Internal champions leave. Innovation focus shifts. Governance impact. Board influence may tilt. Decision-making slows. Strategic pivots become harder. Exit implications. Acquisition may be restricted. Valuation may be influenced by corporate involvement. Strategic buyers may walk away. CVC is not just about growth, it's about long-term positioning under constraint. Corporate venture capital is a strategic tool, not just funding, can accelerate growth or limit flexibility, requires structured thinking, not opportunistic decisions. Founders get it wrong when they focus only on capital, ignore long-term implications, underestimate investor perception. Professionals approach it by mapping risk early, structuring agreements carefully, maintaining independence, thinking beyond the next round. At MP Nerds, we don't just build MVPs. We structure businesses to be investor-ready, scalable, and strategically sound. We help founders validate ideas before capital, map risks before execution, build strategic roadmaps, position for real investment, not just funding. Because at the end of the day, capital doesn't build companies, structure does. If you found this valuable, let us know your thoughts in the comments. Tell us what topic we should break down next. And subscribe for more deep dive insights. Build smarter, scale stronger, think like an investor.